Hello there and welcome to TradingView, where we look at the latest ideas of those experts online, traders, speculators and the like on a largely technical basis. We'll start off with the first chart, we hope, for our bearish BAT target fib levels. That's from Trading Jazz on dollar Canadian. Interesting here, we've got this formation which has been there over the last, week or so, or last month or so in fact, retracing up to that 88.6% level and then looking for it to fall from that zone. I mean, the good thing about this setup really is that it is a decent risk-reward situation, and what also helps, I think, is the way that it looks as though it's already starting to activate from overbought RSI levels above 80, and obviously towards the top of the range over the past month. Looking for a return back towards 129 while we hold below 131.50. So pretty decent risk reward on that if it plays out as we would like. The other point to remember, obviously, with trading, it's not really what your strike rate is, it's actually the ratio of profits to wins. So if you have lots of small profits, lots of small losses, you don't need too many winners in order to cover that and be up in the game. Next situation here, crude oil on the Elliott wave basis from EXCAVO, short there on light crude oil futures versus a price of 44.60. So basically here you can see that we had the ABC correction going into the early part of this year. That also coincided, the C wave, the C wave there coincided with the low that we had just above or just below $26. Since then, a pretty standard or classic recovery. I suppose the turnaround here came with the failure towards that September-October peak, getting up towards the $50 level. That really needed a break. We've got that lower high there below $50. Which is starting to kill the bull argument and help the bears. Could be a big move here to the downside. I'm not quite sure whether I would go for the $12 level there, but definitely looking for a retracement, perhaps back towards that A level of the last month, around the $39 to $40 level, which obviously also ties in with a decent round number. Also backing this idea probably is the renewed risk, let's say, of the Fed raising interest rates, which was alluded to by Janet Yellen at the Jackson Hole Symposium last week. Next market, dollar Canadian. Here we've got a short idea as well. We've got a trend line there over the near term, heading towards, the 132 zone, so something to watch out for there, but looks like a consolidation channel, consolidating that move down from the beginning of the year and a rather flat recovery that we've had. In fact, I mean, that in a way that looks more like a right-hand shoulder, which would break down back down towards the 125 zone. So again, a reasonable risk-reward trade on offer here for people who like this idea, and this, I would suspect, could be a relatively unvolatile trade, especially obviously as compared to trying to trade crude oil at the moment. Dollar Canadian traditionally regarded as the inverse of crude oil, and given the way that Canada is such a big oil producer, but hopefully a less rocky ride than going short of crude oil. Moving on to the Kiwi dollar, the New Zealand dollar versus the Australian. A simple idea, allegedly, according to TNT Sunrise. We've got resistance coming in there towards the 73 handle, and likely failure after the extended topping out that we saw over the course of August. This is the 4-hour chart, so something to remember there. 4-hour chart tends to be one of those favored by professional traders. It just seems to be the right mix of near term and longer term, and really towards that 72, 92, 50% Fibonacci level, there could be a sell into strength opportunity. Going for eventually down to 71, which would test the August support. Again, another decent risk-reward situation. All right, that's it for TradingView this week. Hopefully we'll see you again soon next week.